In 2005, a man with a glass eye and no friends on Wall Street sat alone in a small office in San Jose, reading mortgage documents that almost no one else in the world bothered to read. He wasn't a banker. He wasn't a trader. He was a former doctor who had quit medicine to manage money. And he was about to make a bet so strange, so against everything the financial world believed, that when he first placed it, his own investors thought he had lost his mind. Within 3 years, that same bet would make him one of the most talked about investors in modern history and expose one of the biggest lies the American financial system had ever told itself. This is the story of Michael Burry and the bet that broke Wall Street. Before we go further, if stories like this keep you hooked, hit like right now. It genuinely helps this channel grow, and it takes 2 seconds. All right, let's get into it. Picture the middle of the 2000s. Home prices in America are climbing every single year. Neighbors are flipping houses for profit. Banks are handing out mortgages to almost anyone who asks, no matter their income, their credit, or their ability to actually pay it back. It felt like free money. It felt like the system finally figured out how to make everyone rich. But Michael Burry saw something else. He wasn't looking at home prices. He was looking underneath them, at the actual mortgage bonds banks were selling to investors. These bonds were bundles of thousands of individual home loans, packaged together and sold as safe investments. Burry did something almost nobody else in finance was doing. He read the paperwork, not the summaries, not the ratings, the actual loan documents one by one. And what he found terrified him. Millions of these mortgages were what called subprime, loans given to borrowers who, statistically, were unlikely to keep paying for long. Adjustable rates that would spike after 2 or 3 years. No income verification. Multiple mortgages on the same shaky income. The ratings agencies, the same institutions investors trusted to grade risk, were stamping huge portions of these bundles as safe, nearly risk-free. Burry believed that was a lie. But here's what almost nobody knew at the time. There was no simple way to bet against these mortgage bonds. The tool didn't really exist. So Burry built one. He went to the biggest banks in the world, Goldman Sachs, Deutsche Bank, Morgan Stanley, and asked them to create a financial contract called a credit default swap on mortgage bonds. In plain English, he was asking to pay a premium every month in exchange for a massive payout if the housing market collapsed. The banks thought he was handing them free money. Housing never crashed nationally in modern American history. To them, this was an easy yes. Imagine being in that room. A former doctor, not even a Wall Street native, convincing some of the most powerful financial institutions on earth to take a bet they were certain they'd win. They had no idea what was coming. Now here's where the story turns from strategy into something far more human. Burry didn't just risk his own money. He managed a fund called Scion Capital, filled with other people's savings, teachers, retirees, everyday investors who trusted him to grow their money safely. And for the bet to pay off, those investors had to sit and watch their money shrink month after month, while housing prices kept climbing and the fees for the bet kept draining the fund. Some investors panicked. Some accused him of losing control. Letters came in demanding explanations. A few even tried to pull their money out entirely, which legally he had to fight to prevent, because pulling out early would have destroyed the very bet he believed in. Put yourself in his position for a second. You believe with everything you have that a crisis is coming. You've done the research. You've read the documents nobody else read. And the people trusting you with their life savings are telling you that you're wrong, that you're reckless, that you're going to ruin them. That kind of pressure breaks most people. Burry didn't break, but it cost him. Later, he would describe those years as some of the most isolating of his life. Cut off from friends, doubted by his own investors, betting everything on a truth he could see, but almost no one else could. We'll come back to what happened to him personally. But first, let's talk about why almost no one else saw this coming. This is the psychological trap that catches even brilliant people. When something has never happened before, humans assume it never will. National home prices hadn't dropped significantly in decades. So an entire industry, banks, regulators, ratings agencies, everyday buyers, built their decisions on an assumption that had simply never been tested. It's the same bias that convinces people a stock will keep rising just because it always has, or that a relationship is safe just because nothing bad has happened yet. Past comfort gets mistaken for future certainty. Burry refused to accept that shortcut. He wanted evidence, not history's silence. And slowly, the evidence started catching up to him. By 2007, cracks began appearing. Borrowers who took out those risky adjustable loans started missing payments as their rates reset higher. Foreclosures ticked up in scattered pockets across the country. At first, most of the financial world dismissed it as a minor, contained problem. It wasn't contained. It was the beginning. If you're getting something out of this story, drop a comment and tell me what part surprised you most so far, because what happens next is even harder to believe. Through 2007 and into 2008, the cracks became a collapse. Mortgage-backed securities that were rated as nearly risk-free started losing value at speeds no model had predicted. Major banks that had leaned heavily on these mortgage bonds began reporting catastrophic losses. Bear Stearns, one of the oldest investment banks in America, nearly collapsed and was sold off in a matter of days. Lehman Brothers, a 158-year-old institution, filed for the largest bankruptcy in American history. Millions of American families lost their homes. Retirement accounts vanished. Entire communities that had been built on the promise of endless rising home values watched that promise disintegrate in real time. It was one of the most painful financial events in modern American history. And in the middle of that devastation, Michael Burry's bet, the one his own investors had begged him to abandon, paid off in a way few people in financial history ever experience. Scion Capital's positions against those mortgage bonds turned into enormous gains. Burry's fund reportedly delivered returns far beyond what almost any investor achieves in a single event, turning a fraction of the fund's capital into hundreds of millions of dollars in profit for his investors, and tens of millions personally for Burry himself. The same people who once doubted him, who tried to pull their money out in fear, ended up profiting from the very conviction they had questioned. But here's the part almost nobody talks about. Winning that bet didn't feel like victory to Burry. He had just made an enormous amount of money by correctly predicting a catastrophe that devastated millions of ordinary families. There was no parade, no celebración, just the strange, heavy weight of being right about something that broke so many people's lives. He eventually closed Scion Capital not long after, worn down by the years of conflict, scrutiny, and isolation that came with being the one person willing to bet against the entire system. So what's the actual lesson here? It's not just bet against the crowd and get rich. That's the shallow version of this story, and it misses the point entirely. The real lesson is about the discomfort of independent thinking. Burry didn't succeed because he was smarter than everyone on Wall Street. He succeeded because he was willing to do the unglamorous, tedious work of reading the actual documents instead of trusting the summary everyone else accepted. He was willing to be doubted, mocked, and nearly forced out by his own investors because he trusted evidence over consensus. That's a brutally hard thing to do with your own money, let alone someone else's. Go check the actual data. Question the story everyone assumes is true. Ask what you're accepting simply because it's never been questioned before. That instinct doesn't just apply to housing markets. It applies to every major decision you'll make with your money in your life. If this idea is clicking for you, share it with someone who needs to hear it, because most people never stop to question the story they've been handed. Today, echoes of that same overconfidence still show up everywhere. In markets that assume trends will continue forever, in industries convinced disruption can't touch them, in everyday people who assume their financial habits are safe simply because nothing bad has happened yet. Michael Burry didn't have a crystal ball. He had patience, discomfort, and the willingness to read what everyone else ignored. Somewhere out there right now, someone is looking at the fine print everyone else is skipping, and history says eventually they'll be the only one who saw it coming. Subscribe, because the next story might just change how you see money forever.